We are very happy to see you all here tonight. And Dr. Watson is ready to present on practice profitability. He would like to answer your questions as they arise. And I will be helping him to field those questions. So since all of you are on mute, if you could please add your questions to the chat box, and then I will pause him in an appropriate time and share the question out loud, to which he will respond. So Dr. Watson, are you ready?
I think so. We're all ready. We want to discuss tonight the different kinds of profitability, specifically cash flow and earnings. These are two different perspectives to profitability. Let me say at the outset, though, to reiterate what Evan had said, I like to look at this as if we were all in one large room and there were questions fielded, and you raise your hand and I'll try to respond to the question at that moment before we go to the next slide. So I'll hesitate between slides to try to accommodate questions as they arise. This is a relatively brief presentation, so we have plenty of time for questions. I'll do the best I can to field the questions. So why did we select the subject of profitability? Over 30 years of doing this, it's always been a problem to me. It saddens me to have to present a presentation or a valuation of a practice to someone and tell them that their practice is worth 20, 30, 40% of gross, when they're absolutely positive, because everyone's told them so, that it's worth 100% of gross. The practice has not been as profitable as it should have been over time. Therefore, the value and the saleable price is not what it might, what one might expect. So I've been on a crusade for many years to address the problem and the issue of poor profitability. And so we're here tonight to try to address this as well. So we all have places to be, things to do. Let's just get right into it. The first perspective of profit would be the adjusted net cash flow. Cash flow can be defined a couple of ways. Basically, it's the owner's total discretionary income. It is the income in the practice that's available for the owner to spend at the owner's discretion. Another way to say this, after all major recurring operating expenses have been met, major and minor as that goes, all the operating expenses, the true recurring operating expenses have been met, what's left over is the cash flow available to the owner. So as we see on the screen, this cash flow, look at this as if it were a pile of money. In this cash flow, the owner's compensation is included. That's the discretionary income to the owner. All the perks, fringe benefits available to the owner, owner's insurance, benefit programs, family members perhaps that are paid in the practice, through the practice, but are not really employed by the practice. Other perks and fringe benefits, automobiles, that sort of thing. What's going on here with my slide here? Can you see this? There you go. Perks and fringe benefits that are available for the owners, things that the owners run through the practice for their own benefit that are not really relative to operating expenses. Another element of cash flow would be the one-time non-recurring expenses. An example of this could be maybe a consultation fee, the real estate appraisal, maybe a practice appraisal. Maybe there was a marketing program or something that had been implemented last year was unsuccessful, or it's not a recurring, you discontinued it. Any type of one-time expense that doesn't recur, we would put that into the cash flow pile. Expensed capital improvements. The capital improvements would be, maybe you purchased a piece of equipment, and rather than depreciating this over time, you just, for a quick tax benefit, decided to just write it off. But it's not a recurring expense. It's not an operating expense. It would be a capital expense. Maybe there was a new roof, a new air conditioner, something with the real estate that just was expensed as repair and maintenance, but it's really not a recurring operating expense. Other types of operating expenses would be the interest, depreciation, amortization. Interest is a real expense. It's a legitimate tax deduction, but we look at this as if it were a personal expense. We all have interest because we don't have the money, so we borrow it. Or we have the money and don't want to part with it, so we borrow the money. But nevertheless, it's not an operating expense. Another way to look at this is when a practice is appraised, we look at this, we being the appraisal industry, we look at this as if it were a cash transaction with no debt, and we're just appraising the practice, the business, as if there were no interest. Depreciation, of course, is a write-off of the tangible assets in the practice. It's not a, you don't write a check for depreciation. It's a tax write-off. Same with amortization. Amortization is nothing more than depreciation of your intangible, your goodwill. At some point along the way, maybe your accountant put some goodwill on your balance sheet and they're writing that off over a 15-year period. But again, it's not a real expense. So these kind of things are added back and included in the cash flow. Then there are examples of normalized expenses. So there may be certain expenses that the appraiser would consider to be excessive. Rent could be more or less excessive. There could be more doctors in the practice that are really required, and that would be left up to the appraiser to make an assessment of the various kinds of expenses that should be normalized. Let's just look at this, for example. So on your tax return, there'll be some income. This is a very simple presentation of it. And there would be expenses and your net income on the tax return. The appraiser would go through these various expenses and select those that are should be added to the net income or subtracted from it. An example of something that would be added to would be the officer's compensation. So this $213,000, we would add the officer's compensation to that. So this would become $126,000 greater. I see there was no rent here. So as we'll see in a few minutes, the tenant, the practice must pay rent. So we would need to create a rent expense. So we'll discuss that in more detail, but we would create an additional expense here and subtract that from the cash flow. So this cash flow adjustment, that's why we call this adjusted net cash flow. We make various adjustments, pluses or minuses, depending on what the expense is, as to what should be added to or subtracted from the net income to become the cash flow. We want this cash flow, ideally, in a well-managed practice, we would like to see this somewhere in the high 20s to low 30s as a percentage of gross. So I'm going to the next slide. We've been here. Now that's the cash flow. We'll come back to the significance of that in a moment. But now let's look at the earnings of the practice. Earnings, this is your real profit. So we look at earnings here. In the cash flow, as we saw a moment ago, that includes owner's compensation. We need to make an adjustment in the cash flow, some adjustment for the chief of staff doctor. That's typically the owner. But we treat this as if the chief of staff doctor were paid a fair market salary. So this fair market salary would be, think of this, if you were to be an absentee owner in the practice, what would it take to hire someone to fill the position of chief of staff managing doctor? So this would be a salary that you should have paid yourself for being the managing doctor, not for being the owner, but for being the managing doctor. So after that is removed from the cash flow, what's left over is the earnings. So if we look at this, again, this is the cash flow pile. Everything's in here: owner's compensation, perks, fringe benefits, etc. If we just removed the upper level of this and paid the chief of staff doctor, now we've got management paid, operating expenses paid. What's left over down here would be the earnings. This is your real profit. After management has been paid, real, true, necessary operating expenses have been met, then the profit or the earnings have left over. You might have heard the term Ebitda. Ebitda, the earnings before interest, depreciation, taxes, and amortization. So Ebitda is your profit, your earnings. And in a well-managed practice, I like to see this somewhere in the mid to high teens as a percentage of gross. Well, let me qualify that. It generally takes somewhere in mid hundreds, 400, 500, 600,000 before a practice starts demonstrating any profit. Once the expenses have been met, the chief of staff doctor has been paid, the earnings don't start appearing until 500,000 or so. And then maybe a mid-sized practice, 6 to 8 or 9, might have some earnings somewhere in the high teens. I mean, the high single digit to a low single digit. It may be a millionish or more before a practice starts earning in the mid to high teens as a percentage of gross. So I would not expect a low grossing practice, say 300, 400, 500,000, to be demonstrating any degree of profitability. So the earnings of the practice is what creates the value. And so we'll be demonstrating the difference between cash flow and earnings and the significance of each regarding the price of the practice and the value of the practice. So let me pause here for a moment. I'm not hearing or seeing Evan. Am I getting any questions?
I'm still here. Yes, there are no questions that have come in right now.
We'll continue just to make sure that we've got that field open. So let's continue. So what is the significance of profit to the value? And the practice is appraised, any small business in America, let's not say any, but a business that's appraised on the income that it produces. It's an income approach to value. And this is the typical way that a veterinary practice is appraised. It's based on the income that it produces. The income meaning the profit that it produces. And we convert this profit to value by capitalization. What do we mean by capitalization? In its purest sense, it has to do with a return on the investment. Anytime we invest money into an asset, we expect a return on that investment, the return on the investment. So we're going to invest money into a veterinary practice. We expect a return on that. And the greater the risk of the investment, we would expect a quicker return and a greater return, and vice versa. And there are differences in practices, of course. Some are more risky than others. That would be true with any investment. Some investments are more risky than others. So it has to do with the element of risk. We've determined, we being Simmons and Associates and the veterinary practice appraisal industry, over time, the industry of appraisers, we've all discovered that most general veterinary practices, small animal veterinary practices, statistically will appraise and sell somewhere in the order of magnitude of 4 to 6 times earnings. It could be less, it could be more, but a common range would be 4 to 6 times earnings. So we at Simmons will go through a set of risk factors, and I'll try to assign a risk factor to each element of risk, and there's several. So we'll assign a number to each one and try to objectively arrive at a capitalization multiple. Is it going to be 3.5, 4, 6, 5, what have you? So I try to reach it objectively. I don't just pluck a number from the air. So you could say 5 times earnings could be an average. So let me.
Dr. Watson?
Yes.
We have a question. Someone asked, what do you classify risk as?
The risk factors. Well, there are many, but some of the factors influencing risk would be the type of practice. A general small animal practice would be much less risky than an equine practice or a large animal practice. The clients are just more stable. So the type of practice, the demographics of the area, an area that's growing demographically would be less risky than one that's maybe mature and maybe in a state of decline. That said, well, the demographics, without going into a lot of detail, will definitely have an effect on the risk. The client quality could be an element of risk. The compliance of the clients, average transaction charges, the willingness of clients to pay for your services, the fee structure. Can your fees be increased? If low fees could be an element of risk, knowing that they need to be increased. Will your clients accept an element of fee increases? The need for improvement in the practice. There could be various things that need to be improved. When you make some of these improvements, what's that going to do to the practice? Staff quality, poor quality staff, and to try to change the staff, that's could create risk. If you had to relocate the practice, certainly there's risk there. A practice that's in a rental facility could, depending on the rent, the lease agreement, that could be risky. So there are many. Those are just some examples of risk. But let me say this. Here's where we were. This multiple. There is no universal formula. We're working on one at Vet Partners, but there is no universal formula that all appraisers will utilize and arrive at exactly the same multiple. There would be differences of opinion as to the adjustments made and to how we arrive at this capitalization multiple. just as there would be differences of opinion amongst real estate appraisers in their capitalization of the real estate income.
Okay, we have one more question.
Here,
Someone's asking if you can define earnings, and is that the same thing as profit?
yes,
We would need to go back a few slides, maybe.
yes, yes. Earnings and profit are the same thing. They're interchangeable. Your cash flow back here, this is not your profit. This is the discretionary income. The profit of the practice is what's left over after the doctor has been paid a fair market salary for being the managing doctor. All expenses have been paid. Managing doctor has been paid. Everything left over is your earnings or your profit. Let me say that another way. The owner of a practice gets paid three ways. The owner earns a managing salary, let's say here, a fair market salary for being a doctor, and some of that for being a manager. And then by virtue of ownership of the business, the practice, the owner also receives a return on the investment. So that's the profit. If the owner is the landlord, the owner also receives rent from the facility. So we okay there, you think?
I think we are okay there. We do have another question. How does the equipment factor into fair market value?
Let me come back to that. Hold that. That can take quite some time.
Okay, I'll
definitely,
remind you of that
definitely
one.
it could be addressed. It's a good question, but that can take some dialogue and some time. Hold that till the end, okay?
Okay.
All right. So let's move here. We're converting profit to value still. Let's just give you another idea how this works. So let's look at three examples. We've got, say, three different practices, each one earning $200,000. So the profit of each one of these practices is $200,000. That means that each year, each one of these practices is returning $200,000 on the investment. We're going to determine the risk of each one of these and decide, based on the profit that's being produced, what we would be willing to pay. So we'll look at the first one here, and we would say this is a very fine, low risk practice. It's got everything going for it. There's very little risk in buying this practice. So we might pay 6 times earnings for this practice, $1.2 million. Every year, let me go back to a slide just to emphasize this. This capitalization, the greater the risk, the quicker we want our money back. And the greater the return on the investment, we get our money back more quickly. So here, we have very little risk, less risk than this practice, let's say. So every year we'll get $200,000 return on the investment. It takes us 6 years to get our 1.2 million back through the investment. This one we'll go through our own little assessment. We assess the assets and of each one of these, the attributes, the risk factors, and we determine that this practice is a little bit more risky. So we're only going to pay 5 times earnings. My mouse is disappearing. 5 times earnings for this practice. We would only pay $1 million for this. So each year we pick up $200,000 in earnings and we get our money back in 5 years. It's more risky. This last practice is riff with risk. It's much more risky than all of the others. It's still earning $200,000, but the risk of that earnings remaining and the other risk involved we're only going to pay four times earnings for this practice. We're only going to pay $800,000. So we'll have our money back in 4 years, $200,000 over 4 years. We'll have our $800,000 back. So the greater the risk, the less we're willing to pay, and the quicker we get our money back. So let's go back to cash flow. We said the conversion of profit converts to value of the practice. Now, the cash flow is what determines the maximum price that one can pay. The lender, we now have a price on the practice. We have a contract that spells out the price and the terms of the practice. We have a contract. We have a tax return. We have a lender. We have a buyer. And the lender will look at the tax return and determine the cash flow. The lender will look at the contract and determine the debt service based on the price of the practice and the terms of finance. So the lender will be able to determine the cash flow. The debt service. Also, the lender has a buyer, and the lender will determine what that particular buyer must be able to pull out of the practice to satisfy their lifestyle. And it varies from practice to practice. At this point, we're not talking about value. We're talking about the price that's been contracted. The lender will consider the cash flow. Let's look at this as if it were a bucket of money. And in this bucket, the lender will ensure that there's adequate cash flow to service the debt. The buyer's bank payments come out of this bucket. Also, the lender will determine what that particular buyer must be able to pull out of the practice to satisfy their lifestyle. And that'll come out of the bucket. So this bucket of money, the cash flow money bucket, let's say, has to be adequate to service the debt for that particular transaction and that particular buyer. And the lender will not allow the debt service and the buyer's personal lifestyle requirement to consume all of this cash flow. There's got to be some left over for a rainy day. So.
Dr. Watson?
Okay.
Okay, we have another question, more on profit. They want to know, at what point does the owner doctor decide if you should pay yourself as a sole proprietor or S Corp?
Say that again.
At what point does the owner doctor decide if they should pay themselves as a sole proprietor or an S Corp?
Oh, that.
And he goes further to say, because of self-employment tax versus being on the payroll, I haven't found a straight answer on this yet.
Well, that's a tax matter. That's really unrelated to value, regardless whether it is a corporation or sole proprietor, S Corp, what have you, C Corp. Regardless what the tax structure is, that tax structure basically is a decision that's made between the CPA and the owner, and that would be for tax purposes. But regardless what it is, in that structure, whether it's C, sub S, sole proprietorship, there should be some reasonable fair market salary expensed on the tax return for the owner, and that should be a reasonable fair market salary. Let me maybe go back to this slide to demonstrate here. Here we go. So let's just suppose that this owner, this salary might be. We're trying to determine the earnings of the practice. And let's suppose this salary were $200,000. And realistically, we could say that maybe a reasonable fair market salary would be, for this particular practice, could be $150,000. We would leave $150,000 in as a real expense for the owner, and that other $50,000 would go back towards the cash flow. I'm not sure if I complicated the issue there, but to try to answer the question, it doesn't matter how the tax structure is created. There must be some reasonable fair market salary allocated to the owner for being the chief of staff doctor. Think I got that?
I think you did. And
Okay.
we had in the meantime, we had another question come in.
Okay.
What are typical debt service ratios for veterinary acquisition or startup debt?
Debt service ratios. I guess that would be the debts, talking about the debt to the price to debt ratio, maybe we're talking about.
They term it
All right,
debt
well,
service ratios.
Well, let me answer it this way and
It
see if
says debt service to gross earnings.
debt service to earnings. The earnings to debt service, it's a good question, but it's complex. Let's go back here.
How are we on time? Do you think we should come back?
We have time. Well, I'm not sure I understand the question. As far as the debt on a practice, most practices are leveraged practically to 100%. Most buyers have very little cash, and in many cases, the entire purchase price can be financed through a commercial lender and or the buyer, of the owner financing. So as far as the debt to price, it's commonly 95% or better. As far as the debt service, I don't think I understand that question. The debt service to gross revenues, but can we hold that to the end, and I'll try to come back and get some more clarification on that.
Yes.
So we got the equipment.
And by the way, if any of your questions do not get answered fully, you can always schedule a call with Dr. Watson to
Absolutely, or any one of our associates in any of the offices. We've got 11 around the country and one in Canada, so any of our offices are open for your conversation and questions that might arise. And certainly feel free to call here if not me, any of our staff members can address your questions. So good point, Evan. Okay, the money bucket again has to service the debt and the buyer's personal compensation, and there must be some left over. So we've got cash flow and we've got value. Does the price of the practice, does it have to, or should it equal the value? Ideally it does, but as much as I wish that our company appraised every practice that were ever sold in America, as much as I'd like to see that, that doesn't happen. most practices, I would say most, if not most, many practices are sold without ever having been appraised. The owner has some idea of the price that he or she wants. They put it on the market and a buyer agrees to it. A lender will determine that the cash flow is adequate to service the debt, and the transaction goes down. So the price of the practice is what's actually paid. And and I see it quite often happen, that we'll appraise a practice and I know that that practice will not sell for that price. The value of the practice, it's rare, but we could value a practice that's so perfect in every way that the value might end up being, once we capitalize the earnings and capitalize to arrive at the value, it could turn out to be 130 or 140% of gross. And I know that our market's not going to accept that. The buyer market is just not willing to pay 140%. And if they were, the lender's not going to lend the money. So I know that 140% of gross, even though I can demonstrate that the capitalized value, the earnings are there, the profit's there, and the risk is low, but I know that the market's not going to accept it. Vice versa. You might have heard of no-low practices, the very fine practice that's got everything going for it. It just hasn't been managed for profit. And those usually are high grossing practices. One could afford, and the value, the capitalized value might turn out to be 20 or 30% of gross. And the practice has just got everything going for it. But the price might support a value, the money bucket, the cash flow. I said the price, but the cash flow might support, and typically it does support, a price that could be greater than the value of the practice. So there are many reasons why price and value don't have to be the same. Ideally, I like for, if I'm handling a listing for practice, it helps me for the price to equal the value. The reason is I will go through a process with the buyer and demonstrate exactly how we arrived at the value of the practice and how this value has been converted to price, and how the cash flow can support the price, and how they can afford it, what their after debt income would be, what the debt service would be. So it helps to be able to demonstrate the valuation process, the financing process, and their personal income. But that doesn't always happen. So at this point, we have discussed the capitalized value, the difference in value and cash flow, and what the significance of each one of those is. We'll change the subject a little bit. Any questions so far? We're doing okay? All right.
Yes, there is a question that just came in, and I am not sure whether or not you'd want to put it to the end. Well, now my chat box isn't coming up. I'll try to get back to it. So
Okay.
keep me.
So we'll proceed. So how are we going to increase profit? What do we do here? Well, in its simplest element, it's quite easy to say, just gross more and spend less. However, I'm not going to leave you with that. We'll go into a little more detail, see if we can make this a little more applicable. In most practices, the three major expenses are your drugs and supplies, your lay staff, and your rent. So we want to try to control these. I would say maybe 40 to 50% of your or greater of your total expenses are created, or your total expense are created by these three expenses. Let's take a look at the drugs and supplies first. I have an asterisk here. This applies, let's assume that a typical practice, well-managed practice, is about 85% doctor production and about 15% non-doctor production. As this 85% varies, then the drug and supply inventory could vary accordingly. To exaggerate, and I like to exaggerate to make a point. I'll come back to the exaggeration. In this well-managed practice, about 85% of doctor production, I like to see the drug and supply inventory somewhere in the high teens to low 20s, and not the inventory, but the expense. The drug and supply targeted ideal expense would be somewhere in the high teens to low 20s. So let's come back to this 85%. In a practice that, let's just suppose the practice had 50% of its revenue was created by drugs and supplies, non-doctor revenues, then these expenses would increase. And I've got this covered down here. I'll come back to that. But this 85% would be considered a typical practice. With that, I'd like to see the high teens to low 20s as a percentage of growth for drugs and supplies. Now, occasionally, we might normalize. That means if we see drugs and supplies, obviously there's no management and the drugs and supplies are just out the roof. They're significantly higher than they should be. We might normalize to some small extent. We might make the assumption that although the practice is spending 40% of its revenues on drugs and supplies, we can clearly see that there's no management there, and all it would take would be a slight amount of attention to this expense, and we could control this down to some lesser expense. We're not going to normalize it down to the high teens and low 20s, but we might normalize it back to 5%, maybe add 5% back. So if it were 40%, we might normalize it to 35% of gross or so. That's just an example. So normalization does take place in some practices when there's an obvious reason for a very high expense. So
Dr. Watson?
Yes.
Somebody asked, how does the high teens account for customer online purchasing?
How does what, the 85%?
The high teens to low 20, that ideal target, does it account for online purchasing?
Yeah. Once again, if there's a high degree of revenue generated by your drugs and supplies, whether online or on the shelf, if the percentage of gross generated by your drugs and supplies is high, that's going to affect your profit. So regardless how the drugs and supplies are sold, I like to see in a well-managed practice that's going to produce the greatest profitability, you should try to control that to somewhere in the high teens or low 20s. Maybe let me go down here. That might answer the question. This increase, the drug and supply expense will increase with non-doctor revenue. So your over-the-counter sales, whether these over-the-counter or through your on the shelf or through the online sales, regardless, as these revenues increase through OTC sales. These are low margin items typically. Your doctor produced revenues are the most profitable. And so your OTC and your other non-doctor revenues are less profitable. So the more revenue that's generated through non-doctor revenues, your profit would decrease typically, because your revenues are generated by low margin items. The practice size. To some extent, I'm not going to condemn a large practice by any means, but to some extent, efficiency with the growth in practice size, there becomes a point where efficiency diminishes, and different. There are more doctors in the practice. Each doctor uses different products, and so the demand for more products to accommodate the doctors increases. And so commonly you might expect that the drug and supply would increase above this level the more doctors you have, because each doctor's personal preferences. Also, inventory shrinkage. For whatever reason, we determined that inventory is being purchased, but it's not being sold. So we spend the money to purchase the drug and supply inventory, but for some reason it never gets to the revenue. And that's inventory shrinkage. It's not a nice thing to talk about, but it's a reality. And we are suspicious of this sort of thing many times when we see a very high drug and supply expense, and presumably they're managing it, but for some reason it's not being converted to revenue. So it's a possibility, and it is a reason for the increase in this drug and supply expense.
Okay, Dr. Watson, we've had a few questions
Okay.
on the slide. So I'm going to start from the most recent and work my way back. What would be included in supplies in this breakdown? What kind of supplies are we referring to?
Well, your medical supplies, laboratory supplies, all your supplies, your inventory, your office supplies, operating surgical supplies, medical supplies, OTC products that you sell. All of those are included. If it's a supply, office supply, medical supply, laboratory supply, surgical supply, all of those.
And does it include lab fees?
No, the lab, the products to support the lab would be included as a supply, but not the lab fee. In other words, I think maybe the question, does that include the expense to maintain the laboratory equipment, or to purchase the equipment, or to use the equipment? And it does not, if that's the question. But the products that you purchase through IDEX or whomever, those products are part of laboratory expenses, and therefore your drugs and supplies.
Okay. And and another question. The ideal target that you're talking about, is that a percentage of gross revenue or total expenses?
Yes, percentage of gross. High teens to low 20s. So say 20% of gross would be an ideal target.
Okay.
Yeah.
And one more question, and you might want to hold this off for later, but I'll pose it to you now. Have you seen a trend in corporations over the last few years buying mid-range grossing clinics, 1 to 2 million at a much higher multiple?
So, say that again. Is that on this subject? Say that again. I'm sorry.
Yeah, we might want to hold off on it to the end. Someone's asking about a trend in corporate purchasing. They're asking if we've seen a trend of buying mid-range, of corporations buying mid-range grossing clinics, 1 to 2 million at a higher multiple.
Yes, that's an unrelated question, but yes, without doubt. I think the question is, are the corporations paying more than 4 to 6 times earnings? Is that, if that's the question? Absolutely. They're paying far more than that. I'm talking here about fair market, where the buyer of the practice is a private veterinarian that goes to the bank to borrow the money, as opposed to a corporate practice which has its own cash. But the multiple on the corporate transaction is far greater. I mean, it can be 12, 15, 20%. That can vary all over the place, but yes.
Mm-hmm.
So back to here. So we've got our drugs and supplies. Was there another question related to this?
No.
Okay. So the next, again, this well-managed practice, 85% doctor production, because once we vary from this, the target varies. But again, the same thing. So you want your lay staff somewhere in the high teens to low 20s as a percentage of gross. But this percentage also varies significantly with doctor produced revenues. It increases as doctors increase in the practice, the doctor produced revenue increases, and the demand for lay staff increases. Also, because the doctors require more lay assistance, and also this target, the high teens to low 20 target, can vary with client service. The greater the quality, the greater the client service, the more lay staff that's required to provide the service. And of course, the greater the quality that you offer, the quality it comes with a price and an expense. So you would expect, as doctors increase and client service increases and the quality of the practice increases, so does this high teens to low 20s increases. Facility rent. This is always an issue. The landlord must, the tenant must pay the landlord. So in many cases, as we showed above here, I'll go back to this one. In this case, there was no rent. And in many cases, there's no expense made for rent on the tax return or the profit and loss statement. But as the appraiser of the practice, the tenant must pay rent. We treat this as if it were an arm's length transaction between a landlord and a tenant. They're separate people, and they have to negotiate fair market rent. So it becomes a matter of what is fair market rent. And this fair market rent would be considered triple net. That means in addition to the rent, the tenant also pays the taxes, the insurance, and the maintenance on the facility. So fair market rent, and this rent should not be tied to a mortgage payment. Most people, if they pay themselves rent, will tie it to a mortgage payment, and that has nothing to do with it. It is what it would be if it were a fair market transaction and two people negotiated the rent. And there are a couple of ways to do this. We commonly, being our company here, will allocate a reasonable return on the investment. In this economy, typically 7 to 9% or so, in the Southeast anyway, would be considered a reasonable return on the real estate. In more urban areas, that would be a greater percentage, because rent is just more expensive in the urban areas. But in our practice here, most of our real estate, we will allocate something like 7 to 9% of the value of the real estate as reasonable return on the investment, and that would become the rent. Another way to do that would be a market comparison. So if that's kind of complicated, all practices are not the same. As you well know, some veterinary practices are structurally different than others, and the value in terms of the quality of the facility and the location would vary. So you can't compare practice to practice and say that all practices are worth $25 a square foot. It varies from location to location and quality of the practice. But if you wanted to have someone value your real estate on a per square foot basis, what would the at this particular practice, at this particular location, what would be considered fair market rent? That could become another way to determine the rent price that should be allocated on the tax return. But ideally, the problem we get into here, the rent figure, and I'll exaggerate this to make another point. When the rent, if we're determining the rent based on whether it's on a per square foot basis or the return on the investment, whenever the rent becomes such a significantly high figure, it starts eating into the expenses and eating into profit. Let's just exaggerate and say we have a small practice or any kind of business. Maybe this practice is grossing $500,000, and it's in a piece of real estate worth $2 million. That little practice cannot afford to pay real estate rent on a $2 million facility. So the rent that would be charged at a $2 million facility starts eating into the profitability, and many times to the extent that there is no profitability. So anytime the rent, I'm sorry, this is a misstatement here. When the value of the real estate starts exceeding gross revenues, not the rent would not exceed gross, but when the value of the real estate starts exceeding gross revenues, the commensurate rent for that piece of real estate starts getting commensurately high, and the practice, it becomes difficult for the practice to support that rent. Ideally, we like to keep the rent less than 5% of gross. So I said expenses here. Again, a misstatement. So we want the real estate rent ideally to be less than 5% of your gross, 5% of gross, yeah. And also the rent, the value of the real estate to be less than gross income. So to summarize here, we've got our drugs and supplies ideally in the high teens to low 20s, lay staff high teens, low 20s, and the rent at less than 5%, and you want the rent to be less than gross. So we need to control these factors. So if we're at say 20% here, 20% here, and then 5% here, we've got about 45% of revenues tied up in these three subjects. and the rest is just a variety of different kind of expenses.
Hey, Dr. Watson, we have a question. Triple net. It includes taxes, maintenance, and what is the third factor?
Insurance, fire and casualty insurance. Triple net, rent. Where was that? Rent, triple net here. That includes that is the real estate taxes, the fire and casualty insurance, liability insurance, but mainly fire and casualty insurance on the facility, and maintenance. So in addition to the rent, the tenant pays the fire and casualty, real estate taxes, and maintenance. So this rent is triple net of all the expenses.
Okay, and then on the lay staff section, does lay staff expense include benefits such as health insurance?
Yes, the lay staff is the expense for lay staff includes lay staff benefits.
Okay, thank you.
So here's a recommendation to avoid the problem that I had at the beginning. The thing that saddens me to deliver an appraisal that I know is a low value or lower than one would expect. And I'm recommending you have your practice appraised and let's get an appraisal. Really and truly, you should have your practice appraised every 3 to 5 years. If you're thinking of selling your practice, an absolute minimum of 2 tax years, 2 complete tax years prior to the sale. And what this does, in your appraisal, not only do you get a value, at least if we're doing it, but you will receive information regarding the trouble areas. So we'll troubleshoot the problem areas, and typically those areas are involving your lay staff, your rent. Your rent too, your lay staff, and your drugs and supplies. But we will offer suggestions as to where you're deficient in order to increase your profitability. It could be your average transaction charge. Maybe that's low for your practice. So we'll offer suggestions as to how you might improve your profitability. And you also have time. It takes time to repair an expense problem. You can't do this overnight. It's a paradigm change for many practices, and it creates havoc internally to make these changes, and it's a gradual thing. So it's not a quick fix. So you need to give yourself time to fix the problem. And also, you're not realizing profit, so your personal lifestyle could vary by maybe making a few simple adjustments in your expenses, and this offers more money for you for your personal benefit. So these appraisals, they're fairly inexpensive, and they'll come back to you manyfold. So I would say, when you have your practice appraised, don't go to your neighbor or your friend who has sold a few practices and knows all about value. Go ahead and hire a proper appraiser, and there are many proper appraisers who specify exclusively in veterinary practice professions. Vet Partners, we're members of Vet Partners. You should look them up if you're not familiar with them. But there are many practice appraisers in Vet Partners. We're in there as well. And of course, I would be remiss if I didn't say, Old Faithful, we've been doing this for 40 years or more, and we're always here, and we'd be glad to work with you towards the appraisal of your practice. So I will, before I close this, we had some questions, 2 or 3 that I'll just leave this here and try to answer the questions. By the way, any of you traveling our way, we're right on I-95, St. Simon's Island. And this is what you might expect if you visited us one afternoon. We're halfway between Savannah and Jacksonville, Savannah, Georgia, and Jacksonville, Florida. So visit us anytime. Back to the questions, and I'll keep the slide on and do my best to answer those, Evan.
Okay. Let's see. I'm trying to think of which of priority. Let's go back to the first question related to equipment and fair market value.
Okay. I'm going back here to this slide.
So the question, as a reminder, is how does the equipment factor into fair market value?
Yeah. Okay. I didn't get into this detail, but on this slide, we said that the earnings, the profit should, in a well-managed practice, should be somewhere in the mid to high teens. So this is for the higher grossing practices. This is the earnings generated from the complete entity. It's the earnings generated from the goodwill, the medical records, the inventory, the equipment, the whole ball of wax is tied together as one entity, and they all produce profit. If you try to remove the lay staff, the equipment, the inventory, the doctors, any element of that entity, if you try to remove it, what's going to happen to revenues? It will plummet accordingly, depending on what you remove. But you really can't remove any of those key elements, your doctors, your lay staff, your inventory, and your equipment. So each of those produces, each of those is key to the production of revenue. So these revenues, these earnings are generated from the complete entity. The question involves something called excess earnings. Excess earnings would be the earnings generated from the intangible alone, the goodwill. So in order to determine the excess, the value of the goodwill alone, we have to try to separate the different components of value. We would separate the value of the inventory, the value of the equipment, the value of the goodwill as 3 different components, and make an effort to evaluate each component and then total the 3. It's a totally separate process. It's a different method. But for those older of us who are older, it might recall it's the old veterinary economic, the VEDEC method of valuation, excess earnings. It's not commonly used. There's some fallacies in the ability to determine the equipment value. And is the equipment value going to be the book value, in which case it could be 0, depreciated to 0? Is the equipment value going to be the liquidation value, as if the practice were to be closed and the equipment sold on the street to the highest bidder? No, that's not it. Is the value of the equipment going to be the fair market value, as if it were sitting in a warehouse waiting to be sold? Well, it's getting close, but that's not the value of the equipment either. It's not in the warehouse. The equipment is in the facility. Not only is it in the facility, it's attached, and it's got lay staff connected to it. bells are ringing. It's operational. Doctors are attached to it, and that inventory, that equipment, and now becomes key to the production of revenues, tied in with everything else. So you're going to evaluate the equipment by which standard, and therein lies the problem in trying to do that. So we verify in the valuation process that the equipment is adequate to produce the revenues that the practice produces. If there's a deficiency in the equipment, and we think that the practice revenues are suffering by that, the capitalization multiple, that 4 to 6 times earnings, that would be a factor in whether we're going to use 4, 4.5. We will assess the quality of the equipment, and that becomes a risk factor. So that's handled in the multiple. That's one of the factors that we consider. I have just hit the surface of this question, and there's a lot more to it, but I think that's the essence of it. So.
Okay, I think so too. And let's see, it looks like we have time for maybe one more question. And there was a question that I saw earlier about the corporate market that I'm trying to come back to.
There's one question about the multiples of earnings in the corporate market. I think we answered that one.
No, it's a different one.
The debt service.
Okay, oh, here it is, related to the post-COVID. Okay, so she says, do you anticipate the current post-COVID inflationary effects on lay staff wages to affect the 20% target? And she goes further to say
the post-COVID impact on lay staff to affect that percentage.
The post-COVID inflationary effects on lay staff wages and the scarcity of those employees to affect the 20% target.
I have to say I don't know. Regardless, it's anytime you have an expense that as a percentage of your gross, as the expense increases, your profit's going to decrease. So regardless, if any expense that increases, whether it's lay staff or what have you, you should control your revenues. You might have to raise your fees.
Okay, so she goes further to explain that they're currently hiring people for $4 to $5 more per hour than they were a year ago, because that's what the market demands now.
Yeah, well, as time goes on, I'm sure we can all remember when gasoline in all of us was 25 cents a gallon. I can remember that. Prices are going to increase, and as they do, if you to stay in business, you've got to raise your fees and your prices as your expenses increase. So with any increase, not just lay staff, but as any expense increases, you've got to raise your fees as well. You should try to keep this target. You just can't let your expense continue to increase without increasing your fees.
Okay. I'm going to throw out one last question. How should we think about associates' cost in the expenses, and what is a target?
That's a new paradigm. This we're hearing this, and I'm sure most here are well aware that that is a significant novelty. We're just beginning to see that in our profession, and I don't have an answer to that. But we would commonly in years past, we would say an ideal target for your doctors And I think we've got a slide here. You like to keep the doctor compensation roughly 20% of gross. I don't think we have a slide on that. But the corporations will commonly have a target for doctor compensation, 20% of gross of doctor production, 20% of doctor production, more or less. And that's a common target that we in the appraisal industry shoot for, that the doctor compensation should hover around 20% of doctor production. But that paradigm, I'm fearing, is about to change, because we're just hearing that where's my slide? Associate availability, it's a matter of supply and demand, is becoming difficult, and the corporations probably have a lot to do with that as well, because more and more associates are being hired by the corporations, and that means the supply is less for the private practitioner. So the question is, how is that going to affect the value? And I don't have a clear answer. Obviously, any expense, including an associate expense that increases, if we're not able to increase the fees to accommodate any increased expense, that will have an effect on a negative effect on the practice value.
Okay, I think that's good.
Okay, well, I've enjoyed being with you, and again, y'all come see us now. You hear? Okay, and we'll hope you have a good evening, and look forward to talking with you one way or the other. So with that, we'll bid you adieu and good evening.